buckle up, because the worst month for the stock market in the entire year has just begun. In a phenomena that challenges the efficient markets hypothesis, the stock market severely underperforms historically during the month of September. But number one, is this even true? Or is this just like an old wives' tale about the stock market? And number two, even if this has been true historically in the past, is there any reason to suspect that this time we are also going to have a terrible September for the stock market? Well, buckle up, because you may not like the answer that we find for those two questions. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to get higher returns with less risk by learning how markets actually work. If you're interested in learning more about that, link is in the description below. Historically, the month of September is the worst performing month out of the entire year. You can see on this chart October, December, and November compared to a terrible September. This chart shows the performance of investing $1,000 during just that month of the year, going all the way back to 1960. Due to the long-term consistency of this pattern, it makes you wonder, why in the world would this effect exist? And it actually has a name called the September effect. Statistically, this bad performance goes back almost 100 years. Now, there have been some key years that have driven this in the past, with some major negative economic activity happening during the month of September. If you include October as well, you end up in prime time crash season for the markets, which includes events such as Black Monday in 1987, 9/11 in 2001, and the collapse of Lehman Brothers. But even aside from these crashes, there could be another reason why September typically has subpar performance, and that could have something to do with the fact that investors are selling towards the end of September as the quarter comes to a close. Gives them the ability to lock in profits coming into the end of the year. And that right there, locking in profits towards the end of the year, is key, and something that is going to come up again later in the video that may be very, very important this time around. But we're not here to worry about the past. We're wondering what is going on right now. Is there anything fundamentally happening in both the markets and the economy that can contribute to a major crash coming up? Now, if you're not new to the channel, then you know I just recently posted a video about a global margin call coming up soon, giving an urgent warning to all investors. And now that the stock market has had a little relief rally, or what I would call more of a sucker's rally, we are primed for some bearish activity. What I've been warning about, I think, will start to unfold over the next month or two. One reason is because of over exuberance in the markets. Take a look at this chart posted by @barchart on Twitter. We can see that the hedge fund net exposure to mega cap stocks is at an all-time high. If you notice, the last time they were close to this high was at the beginning of 2020, right before the markets tanked at the beginning of 2020. Now, it's worth noting that if you're currently invested in a hedge fund that has an all-time exposure to mega cap and large tech stocks, it's not a hedge fund. It's not hedging anything. It's going along with the crowd at record high investments, investing out of fear of missing out and euphoria, putting you at risk while they collect their 2 and 20. Even beyond the mega caps, hedge fund exposure to the Magnificent 7 tech stocks is currently also at a record high. These 7 stocks make up about 20% of the total market value held by hedge funds. These stocks are Microsoft, Apple, Alphabet, Meta, Amazon, Nvidia, and Tesla. All stocks pushing higher, especially Nvidia, on this AI craze that is gonna go nowhere but down. What we are seeing in this space right now is absolutely nothing different than the bubbles that we saw form with NFTs, SPACs, ICOs, .com stocks, and many other examples of irrational exuberance pouring money into things based on literally the opposite of fundamentals. But first, a word from today's sponsor, Silver Bullion in Singapore. They have a revolutionary peer-to-peer bullion secured loan program. This enables you to put your precious precious metals to work by taking out a loan against your gold or silver. Now, because your loan is collateralized by your metal, you get some crazy advantages. Essentially, you get to set your own terms for the loan. First, you get to choose the amount you want to borrow. You can choose which currency you'd like to take the loan out in, like Singapore dollars or the euro or US dollars. You can choose your loan duration, anywhere from 1 month to 2 years. And you can even choose the interest rate that you want to borrow at. Now, the best part is that as a borrower, at no time do you lose any of the full legal ownership of your precious metals. This peer-to-peer secured loan program comes along with many other benefits of storing metal in their Star Storage program. Again, you have full legal ownership always. The vault tests your metals to make sure that they know exactly what is there and where it is. The jurisdiction in Singapore, which is one of my favorite benefits considering Singapore is my favorite country on earth to store precious metals in because they have the highest degree of economic freedom of any nation on earth. They also have industry-leading insurance on top of what is required for things even like mysterious disappearance coverage. Now, there's obviously a lot more to this, so I highly recommend clicking on the link in the description below, filling out the form so you can contact their team to learn more about this amazing program. Link is in the description. So that's just market positioning. The market is primed right now for a big sell-off simply just from readjusting portfolios. There's major overexposure to some of these positions that have driven the entire market higher by concentration in a few very overvalued positions. That alone is gearing the market for a sell-off just from reversion to the mean and a slight correction and rebalancing of portfolios. But what about economically speaking? Is there anything economically going on right now that people need to be worried about? There is one very worrying trend with student loans that I do not think most people are paying enough attention to. 40 million Americans have student loans. This is not a small percentage of the population. These student loans have not required any payments since 2020. In the meantime, since then, people's budgets have become extremely tight, mainly due to inflation, but also because people have spent that money and levered up on even more debt. So now people have bigger bills from more debt and their cost of living is higher. And now student loan payments are about to resume. Starting this month in September, they start to accrue interest again. And starting in October, the payments start. And almost half of all student loan borrowers are expected to go delinquent when payments resume. And this is not like the lenders or other people saying, hey, this is what we expect. This is the borrowers themselves saying, we expect that we're not going to make our payments.
But I can't pay you.
This new survey from Credit Karma said 45% of the borrowers they surveyed said that they expected to go delinquent. Now, that's partly probably because there are no penalties for going delinquent for just the first 12 months. So many of these borrowers are probably thinking that they'll be in a better position a year from now than right now, and they just can't afford it. But no matter how you slice the cheese, the American consumer is not in a good position right now. To pull on that thread just a little bit more, when the consumer is not in a good position, they can't afford to spend. When the consumer can't afford to spend, that means businesses don't have income. When businesses don't have income, that means they have to lay people off and stop hiring. When they lay people off and stop hiring and lower wages, that means people have less income. And when people have less income, they can't afford to spend. And then you get the downhill deflationary death spiral. But there's more trouble brewing other than just on the consumer side. Regional banks are in trouble. Regulators are forcing them to raise their debt levels right now. Essentially, there are a lot of banks right now with massive unrealized losses on their balance sheets that they're not required to report because they invested in treasuries back when interest rates were near zero. And now that interest rates are higher, all those treasuries are at a loss. They're hoping they can hold on to them and just wait until they mature, get paid back the principal and interest, reinvest at a higher interest rate. But if depositors catch wind of this unrealized loss and start to take their money out at too fast of a pace, these banks collapse in a matter of days. We know this happens still today. Bank runs are not a thing of the past because it just happened a couple months ago with Silicon Valley Bank and Signature Bank and First Republic Bank. So the Fed is trying to get ahead of it this time with the other banks it knows are at risk, but the solution will result in higher funding costs, new compliance, and ultimately just may not be able to afford to implement the things that regulators are telling them they need to do. The market was able to recover from from the bank failures that happened earlier this year, but a large part of that was due to the belief that the bank failures were done. If we do get a second wave, it'll become more apparent to market participants that this is a deeper problem that was not fixed back in March. Now, I've been very vocal in the past that I think the biggest threat over the next 5 to 10 years to the United States economy is fiscal policy, the financial irresponsibility of the United States government. We are seeing interest rates surge to multi-decade highs, while the national debt is at an all-time high. Meanwhile, spending is increasing at the same time as tax revenue is decreasing. Literally every single marker of financial health is going the wrong direction. They're spending more, their income is down, they're borrowing more, and their borrowing is at higher and higher rates. And as the US Treasury market is supposed to be the most liquid, safest market in the world, the Treasury is the risk-free asset, it is the foundation of the global financial system. Seeing stress or lack of liquidity in these markets is something that could bleed over very easily into other markets. And the Federal Reserve has recently announced that they have noticed a surge in hedge fund treasury shorts, and they think it's due to a rise of the basis trade again. The basis trade involves borrowing heavily in the repo markets and then using that leverage to exploit the price gap. It's an arbitrage trade between treasury futures and the cash markets. These trades can be levered up 50 to 1 and have low margin or even zero margin funding available to do these trades with. So this massive amount of money that is currently short in the US Treasury market is an indication that these trades are coming back. And the sheer size of these trades and then something happening where these trades all have to get unwound at once is one of the things that caused so much market turmoil in 2020 and in 2019. The widespread use of these leverage strategies could absolutely make the market's volatility much worse, as has happened before. It's worth noting that hedge funds and asset managers currently have opposing positions, with asset managers being net long, hedge funds being net short. A panicked stampede for the exit could very easily cause a lack of liquidity, treasury markets freezing up as everybody's trying to unwind the exact trade at the exact same time. Now, I told you earlier that we were going to come back to the rebalancing of positions in order to take some profits going into year end. This is important because when you're selling stuff to take profits, you naturally have to take profits on things that are currently at a gain. This is going to be your tech stocks, the few mega caps that have driven the markets much higher. And seeing as how there's weakness everywhere else in the market except for just these few companies that are driving everything else, this is a bad sign for market indexes because euphoria is bullish until it turns bearish. And then obviously, once things start to get going and things start falling, things start crashing, people have to sell and liquidate to cover margin calls, to rebalance their portfolios. Automatic rebalancing starts taking place, and you end up selling what you can, not what you want to. Now, like I've said before, I do not think it's smart to try and time the market, completely get out, sell, go to cash, wait for the crash, because I don't have a crystal ball. The only way to make money investing is to bet against the consensus and be right. Right now, the consensus is saying that the market is fairly valued, with the S&P 500 at 4,500. That's what the consensus says. I'm betting against that, but I also have to be right. So I think it's much smarter to have hedges in place, or at least tail hedges, and not try to play these games of fully trying to time the market. Being all out, all in, cashed up, the odds that you're right and the entire market is wrong are probably not very good odds. Hedging your portfolio in a cost-effective way is just one thing that I teach members of Heresy Financial University. So if you're interested in learning more about that, link for it is in the description below. And if this year is anything like years of the past, then it's probably time to buckle up because we may be in for a wild ride. As always, thanks so much for watching. Have a great day.